Pause everything you're doing because what just unfolded in the silver market will blow your mind, and 99% of people are reading it completely backwards. If you hold even a single ounce of silver, whether it's locked in your safe, tucked into an ETF, or buried in mining stocks, the next few minutes could reshape your entire strategy. Silver just suffered its most catastrophic single-day collapse in recorded history. Let that land for a second. We're talking about a 27% annihilation in one trading session, the kind of bloodbath that transforms confident traders into trembling wrecks and sends cautious watchers running for the exits. But here's where things get absolutely bizarre. While silver was nosediving, while every headline screamed apocalypse, while social media declared precious metals dead and buried, retail investors did something that defies all logic. They bought aggressively. We're talking nearly $500 million flooding into silver in under a week. And get this, on that exact day when silver cratered 27%, over $100 million poured into the largest silver ETF alone. So what's really happening? Is this the buying opportunity of a lifetime or the most vicious trap ever set? That's exactly what we're dissecting today, and trust me, the answer isn't simple. Anyone claiming otherwise either doesn't understand the game or they're selling you something. Before we dive deeper, do me a favor. If you're finding value here, smash that subscribe button and hit notifications. We're building something real. Genuine market analysis without the recycled nonsense and hype. Drop a comment telling me where you're watching from. United States, Europe, Asia, Australia, wherever you are. I read every single one, and it shapes how I create content for this community. Now let's get into what actually happened. First truth, silver has never been a normal market and never will be. It's microscopic compared to the ocean of global capital. When big money moves in or out of this puddle, it doesn't flow gently, it explodes. When silver rocketed to nearly $120, then crashed toward 98 in days, that wasn't conspiracy or manipulation. That was simple physics, a tiny market getting hammered by massive flows in both directions simultaneously. Picture a small town with one gas station. If 1,000 cars suddenly need fuel, prices spike because supply can't keep up. But if half those cars leave while more keep arriving, you get absolute chaos. Prices whipsaw violently because the system's too small to absorb the pressure. That's silver. That's always been silver. The volatility isn't a glitch, it is the system. People who get destroyed are those who don't understand this fundamental reality. Here's where the data gets fascinating. According to Vanda Research, retail investors dumped $430 million into the largest silver ETF over just 6 trading days. That's massive for a market this size. And the timing is insane. This wasn't money chasing gains when silver was ripping higher. This was capital flowing in during pure chaos, when every financial outlet ran fear headlines about precious metals collapsing. Over 100 million came in on the single worst day in silver's history. Read that again. On silver's darkest day, retail investors responded by buying over $100 million worth. That's not panic, that's opportunity hunting. That's investors seeing blood in the streets and stepping in. Analyst Rona O'Connell from StoneX nailed it, saying silver's appeal has actually increased because of the massive sell-off. Some investors are viewing this as a chance to buy at lower prices. While headlines screamed fear, while algorithms triggered sell orders, while weak hands dumped everything, a wave of buyers said, "Give me more." But here's the flip side you need to understand. Reports from coin shops across the country paint a completely different picture. Shop owners are literally swimming in so much silver and gold, they're limiting purchases. Think about that. These businesses exist to buy precious metals from the public, and right now they're so overwhelmed with inventory they're turning customers away. One manager said, if you do this wrong, you run out of capital really fast. The peak prices, gold topping 5,300 and silver hitting nearly 120, triggered a tsunami of selling. People raided safes, safety deposit boxes, old silverware collections, anything silver, and flooded into coin shops to cash out. Here's the problem. Coin shops are middlemen. They sell to refineries who melt everything down, and those refineries are completely backed up. One refinery president explained his company stopped buying scrap silver when prices crossed $50 because the surge created an unmanageable backlog. He sat on the sidelines during this entire wild run. Refineries above him also stopped accepting material because they're drowning in inventory. So the entire plumbing system of the physical precious metals market is clogged. Metals flowing in from the public, but not flowing through the system. Coin shops are stuck with more inventory than they want, refineries are backed up for months, and cash is getting squeezed because nobody at the top is opening their doors. Now here's where interpretation splits. The bearish read says all this metal flooding out represents sellers cashing out at what they believe is the top. When Grandma finally sells the silver platter she's owned for 40 years, maybe that signals prices have peaked. That kind of capitulation often marks rally endings. The bullish read says the clogged system means supply is temporarily restricted even as 500 million in new demand tries to push in. If refineries can't process fast enough and coin shops can't offload inventory, actual available supply for buyers is tighter than it appears. That tightness can support prices even when it seems everyone's selling. I won't tell you which interpretation is correct because, honestly, both are true simultaneously. The market is digesting a massive positioning change, and until that completes, volatility will remain extreme. Understanding this plumbing, why prices can crash while buyers step in, is essential if you want to survive what's coming without making emotional decisions you'll regret. Quick question for you. Drop a comment right now. Are you holding physical metal, paper exposure through ETFs or futures, mining stocks, or some combination? I'm genuinely curious about this community's positioning because it helps me tailor future content. Let's address mining stocks because this confuses and frustrates everyone. If silver and gold have made enormous moves, why aren't mining stocks flying? Why do companies like Kerr Mining look stuck in quicksand? Here's the hard truth. Mining stocks aren't the same as owning metal. When you buy an ounce of silver, you own an ounce of silver. It sits there. No employees, no energy bills, no permitting delays, no equipment breakdowns. Mining stocks are complicated businesses operating in hostile environments with massive capital requirements and thin margins that get squeezed from every direction. Kerr Mining is a perfect example. The stock's been acting like a seismograph for investor anxiety. After traders tried front-running friendlier interest rates and firmer silver prices, the mood cooled. Share prices drifted lower. Intraday spikes from metal price swings repeatedly faded into the close. Compared with broader mining indices, Kerr underperformed. Here's what drives people crazy. On a one-year basis, Kerr is actually up significantly, tens of percent from 12 months ago. Gold's up 76% and silver's up 47% over that period. If you invested $1,000 in Kerr a year ago, you'd be sitting on meaningful profit. But the path was brutal. Gut-wrenching drawdowns, double-digit swings, days where paper profits evaporated in hours. That emotional torture is why mining stocks trade at discounts to underlying metals. The market prices in uncertainty, execution risk, the possibility that even if metals soar, the company might stumble. The framework here is, don't treat miners like leveraged metal. Sometimes they amplify commodity moves. Sometimes they disappoint even when metals rip. The difference comes down to company-specific factors like cost control, production ramps, and management execution. If you're owning miners, watch them as businesses, not just metal proxies. Now let's talk psychology, the most important factor determining success or failure in volatile markets. When silver's crashing 27% in one day, your brain isn't processing information rationally. It's in survival mode. It sees a line plummeting and translates that to danger. Heart rate spikes, palms sweat, a voice screams you need to act now before it gets worse. That voice is almost always wrong. That voice is why most people sell bottoms and buy tops. It evolved to keep you alive when tigers chased you through jungles. It's catastrophically bad at financial decisions. That 500 million flowing into silver during the crash came from people who learned to ignore that voice, or at least acknowledge it without obeying. They looked at the same charts, felt the same fear, but had a process. They had a plan. They decided in advance what they'd do if prices dropped to certain levels. When those levels hit, They executed instead of panicking. This separates survivors from casualties. Survivors make decisions when calm. They write down their plan, define price levels that matter, decide in advance how much they'll buy or sell at those levels. When chaos arrives, they don't think, they just execute. Casualties make decisions in the moment. They react to every chart tick, let emotions drive actions, and get whipsawed repeatedly, buying high from excitement and selling low from fear. So let me ask directly, do you have a plan? Not a vague sense that silver's good or you want profits. An actual written plan specifying what you'll do if silver drops to 90 or rips to 150. What position size you're comfortable holding through a 30% drawdown. If you don't have that plan, you're gambling. You might get lucky, but you're gambling. The house in this casino is designed to extract money from emotional gamblers. That's the entire purpose of volatility: shakeouts, fake breakouts, crashes that recover, rallies that fail. Every move is designed to trigger emotional reactions from people without plans. Don't be one of them. Looking forward, the next few weeks are critical. Silver's in a zone where the market must decide. Either buyers continue stepping in on dips and we build a base that can launch toward new highs, or selling pressure becomes too much and we get another leg down, shaking out more weak hands. I'm watching retail flows. If hundreds of millions keep flowing into silver ETFs, that signals real sustainable buying pressure. If flows dry up, enthusiasm's fading. I'm watching the coin shop situation. When refineries start accepting material again and the backlog clears, that removes artificial tightness in the physical market. Whether that's bullish or bearish depends on whether new supply hits a market with strong demand or one where buyers finished buying. Mining stocks are another tell. If silver moves higher but miners like Kerr continue lagging, that's a warning sign suggesting smart money isn't convinced. But if miners start leading or keeping pace with metals, confidence is building. People constantly ask whether they should be in physical metal or paper exposure. Here's my honest take. Physical metal is for people wanting ownership without counterparty risk. When you hold a silver coin, nobody can default on it, change the rules, freeze your account, or require additional margin. Physical is slow, calm, not designed for rapid trading but for long-term wealth protection. Paper exposure through ETFs or futures is for people wanting liquidity and quick execution. You can buy and sell in seconds, use leverage to amplify exposure. But paper comes with layers, counterparty risk, margin requirements that can change at the worst moment, rules about settlement and delivery most people never read until they matter. Neither choice is objectively better. The right choice depends on your personality, time horizon, and goals. Match your vehicle to your personality and plan. Don't let someone else tell you what's right. Here's the most important concept I can share. In volatile markets like this, you don't get paid for being certain. You get paid for having a process. Certainty is a trap. Anyone claiming they know exactly what silver will do next is lying to you, or themselves. The market has humiliated far smarter people than us, bankrupted people who were right about direction but wrong about timing, shaken out people positioned perfectly but couldn't handle emotional pressure. Process beats prediction every time. Process means position sizing you can actually hold through violent swings without losing sleep. Process means knowing exit points in advance on both upside and downside. Process means accepting you won't catch the exact bottom or top and being okay with that. Process means letting the market prove what it'll do rather than forcing your opinion onto price action. If you build a process and stick to it, you'll survive what's coming. If you trade on emotion and impulse, the market will eat you alive. That's not prediction, that's mathematical certainty based on how markets work and how human psychology fails under pressure. Final action items. Hit subscribe and turn on notifications if you haven't already. Drop a comment telling me where you're watching from and whether you're positioned in physical, paper, miners, or some combination. I read every comment and use that to shape future content. If you found this valuable, share it with someone who owns silver, someone confused about what just happened, someone about to make an emotional decision they'll regret. That's how we build this community, not through hype or clickbait, but genuine value helping people navigate confusing markets. Silver won't make this easy. Crashes will be terrifying, rallies exhilarating. The chop in between will test your patience and conviction. But if you understand the mechanics, respect the volatility, build a process and stick to it, you have a chance to be on the right side of whatever comes next. If you're watching this, if you made it to the end, you're already ahead of the crowd that stopped paying attention minutes ago. Use that edge wisely. I'll see you in the next one.